Everyone is wrong about the yen carry trade. Japan just ignited a global liquidity wave, and almost nobody understands how big the implications truly are. Executive summary. Japan has triggered one of the largest coordinated fiscal monetary liquidity waves in modern history. The global macro community is drowning in misinformation, screaming about reverse carry trades, yen strengthening, and global margin calls. They're all wrong. Japan's newest fiscal package forces the BOJ into deeper yield suppression, guarantees a weaker yen, supercharges the global carry trade, and stabilizes the funding backbone of global risk assets. The real story is much bigger. The yen carry trade isn't a niche FX strategy. It's a $2.5 to $4.5 trillion global liquidity engine. And in today's zero DTE plus record leverage regime, its effective volatility exposure is $3.75 to $13.5 trillion. Market volatility in the USD-JPY pair now magnifies margin risk by orders of magnitude. Bitcoin, the world's highest beta liquidity sponge, absorbs this volatility first. Most investors have no idea how fragile the microstructure is, nor how important Japan's policies are in preventing an involuntary global deleveraging cascade. This is the real macro. 1. Japan just launched a liquidity tsunami. The new package includes 42.8 trillion yen total economic impact, 21.3 trillion yen fiscal package, 17.7 trillion yen fresh spending, 18.3 trillion yen supplemental budget, 11.7 trillion yen in new JGB issuance, tax revenue above 80 yen for the first time in history. This is one of the largest fiscal expansions Japan has deployed outside wartime or COVID. Prime Minister Sanai Takaichi is making Japan's stance unmistakably clear. Growth over austerity, liquidity over tightening, fiscal dominance over monetary discipline. 2. More JGB issuance equals more BOJ intervention. Every yen of this fiscal package must be funded. Japan will issue 11.7 trillion yen in new debt, which in a normal market would push yields higher. But Japan is not a normal market. BOJ cannot allow yields to rise because debt/GDP is 260% plus. Higher yields trigger a fiscal death spiral. The BOJ has already committed to a flexible 1% cap. Therefore, BOJ must buy the issuance. Yields stay pinned, yen weakens, carry thrives. This is the opposite of what reverse carry trade influencers claim. 3. Why? Stimulus plus rate hikes is impossible for Japan. A major piece of FUD on X right now is Japan will stimulate and then BOJ will hike. That is economically nonsensical. If BOJ raised rates after approving this stimulus package, Japan would destroy the effect of the stimulus, trigger a massive JGB sell-off, cause a violent yen strengthening, kill the carry trade, risk a recession, blow up domestic banks. Japan chose stimulus. Rate hikes would nullify the stimulus. There is no scenario where Japan both injects liquidity and tightens. This is why USD-JPY is not strengthening. This is why carry is safer, not riskier. 4. Global yen carry exposure, $2.5 to $4.5 trillion. A realistic all-in estimate includes Component Est, exposure, direct FX carry, $125 to $250 billion, hedge funds plus CTAS leverage, $250 to $600 billion, yen-linked derivatives, the true multiplier. $1.2 to $2.0 trillion. EM sovereign/corporate synthetic yen funding. $200 to $400 billion. Bank/dealer exposure plus basis trades. $300 to $500 billion. Total, $2.5 trillion to $4.5 trillion of global exposure, directly sensitive to yen stability. This is why a disorderly yen spike is one of the only catalysts that can cause a multi-asset meltdown. As Gary Stevenson wrote in The Trading Game, markets don't reward intelligence. They reward access. Yen is the cheapest access in global finance. Japan just kept that access open. 5. The hidden multiplier, 0DTE gamma plus record leverage. Here's what makes 2025 vastly more fragile than previous cycles. 61% of all index option volume is 0DTE. Index leverage and open interest are at record highs since last April. Dealer hedging now flips intraday, sometimes hourly. Macro shocks propagate 1.5 times to 3 times more violently. Under a normal options regime, 2015 to 2018, a macro shock that should move markets minus 1% likely stays minus 1%. Under today's regime, the same shock prints minus 2% to minus 3% with air pocket candles. This doesn't trigger the shock, and it multiplies the shock. Now add the yen carry. 2.5 to 4.5 trillion times 1.5 to 3 times volatility amplification equals $3.75 trillion minus $13.5 trillion vol-adjusted risk load. This is what nobody on X understands. The yen carry trade is now sitting on top of the most fragile volatility structure in history. 6. Why USD JPY volatility is now a margin risk cluster bomb. Carry trades are uniquely vulnerable to FX volatility because funding is in yen, assets are in USD, hedging requires daily FX swaps and futures. Dealers hedge dynamically. A rising yen forces immediate deleveraging. A 1% yen strengthening can trigger 10 to 20 times more notional hedging flow from levered carry books. This is why Japan cannot allow USD-JPY to plunge. And this is why the BOJ is effectively forced to cap yields, suppress JGB volatility, maintain USD-JPY stability. Japan's fiscal plus monetary posture is designed to reduce FX vol, not increase it. 7. Why Bitcoin absorbs this volatility first. Bitcoin has become the world's purest liquidity proxy, the highest beta macro asset, a vessel for funding shocks, a real-time indicator of risk on/risk off, the endpoint of volatility transmission in the modern market microstructure. When ODTE flows, flip, ES/NQ volatility surges, USD-JPY spikes, carry margins tighten, funding flows wobble, dealers hedge aggressively. Bitcoin shows it first. BTC is no longer just crypto. It is the real-time pressure gauge of global liquidity. This is why BTC wicks harder, moves faster, and reacts instantly to USD-JPY moves. As the volatility engine intensifies, Bitcoin's correlation becomes explosive, not linear. 8. Geopolitics, Trump plus Takaichi alignment. Recent headlines show deepening U.S.-Japan coordination, Trump bonds with Japan's new prime minister. AP. Trump heaps praise, signs rare earths deal. Reuters. Trump says he had great talk with Japanese leader. Reuters. Japan's leader says Trump called her as dispute with China grows. AP. This matters because a weaker yen helps U.S. markets. Japan's liquidity supports U.S. political priorities. Both sides align on countering China. Washington benefits from Tokyo's continued yield suppression. Fiscal expansion and monetary stability in Japan are now geopolitical tools, not domestic choices. Conclusion. The real macro thesis. Everyone is missing. The yen carry trade is not at risk. It is more supported than ever because Japan expanded stimulus. BOJ must buy more. JGBS. Yields remain capped. Yen stays weak. Carry remains attractive. FX volatility must be suppressed. Global liquidity flows remain stable. At the same time, the market's volatility engine is hyper-fragile. Zero DTE gamma plus record leverage amplify shocks. BTC reacts as a high beta liquidity proxy. USD JPY volatility now holds the entire liquidity structure together. The system's effective carry sensitivity is $3.75 trillion to $13.5 trillion. This is why Japan cannot tighten. This is why the yen cannot be allowed to strengthen. And this is why everyone screaming reverse carry trade has no idea what they're talking about. The truth is simple. The entire global leverage machine depends on yen stability. Japan just ensured that stability, at least for now. If you find this research useful, I'd be grateful if you considered subscribing. Your support directly helps fund deeper modeling and thoughtful breakdowns of emerging digital asset structures like this one. Subscriptions genuinely make this work possible and sincerely appreciated.